This is your Lead Left podcast for the week of December 16th. I'm Randy Schwimmer. Welcome back. What we learned about 2024 is that many worries identified by analysts and market observers came to naught. Rates, economic growth, and inflation, all areas of concern last January, are in good shape as 2025 rolls out. As our chart of the week shows, more robust job growth than expected is just one example. As one banker observed recently, what were headwinds have become tailwinds. The focus now is on mostly global rather than domestic issues. Tariffs, trade, and geopolitical risks are taking center stage. Some of these are theoretical, but could mirror events from 2017 to 2020. And while the rise of bond yields since the election suggest higher inflation to come, capital markets remain full speed ahead, or as a recent Apollo research report put it, firing on all cylinders. We also learned that public and private markets can perform well without one side stealing from the other. Banks focus on larger syndicated corporate deals, and direct lenders on buy and hold traditional and upper middle market LBO financings. That distinction was highlighted by the broadly syndicated market's record $1.6 trillion of loan volume last year per LPC, of which only $84 billion, about 5%, represented new private equity buyouts. PitchBook LCD reported 2024 new issue leveraged loan volume of $500 billion without repricings, a level not seen since the market top 3 years ago. This means rethinking our notions about supply and demand in the loan market. Capital formation is now more about process and predictability. Sponsors demand speed and certainty of execution. They align financing partners with specific borrower needs for growth and acquisition capacity, expanding lender groups as required over time to meet those needs. As we've said before, capital tends to fill a vacuum. Demand in the world of private credit is not a capped resource. Deployment is triggered by the supply of new deals and vice versa. With continuing appetite for the asset class, growing M&A flow will be met with direct lenders offering constructive terms. Finally, while we expect M&A deal flow to continue to improve as global third quarter 2024 numbers highlighted, Lincoln International raised a cautionary note. Quote, surveyed groups reported that anecdotal close rates for 2024 deal launches were the lowest many could recall, with the most optimistic estimate being that only 50% of deals launched in 2024 have closed or are on track to close, and the most pessimistic estimate at a paltry 30%, unquote. Next week, we turn to the first of our 5 themes characterizing the 2025 outlook. Still higher for longer, what slower rate cuts mean for private capital investors. Firing on all cylinders here at the Lead Left, this is Randy Schwimmer, wishing you and your families a safe and healthy week.